Welcome back, traders and investors. We have Matt Porzio, VP of Product Marketing at Intralinks. Matt, how you doing today?
I'm doing great.
So you got the latest report of the deal flow indicator coming out today. We've had a few mergers going on. We'll go those in a second. But the general trend is it seems like the street is still pretty optimistic on future M&A activity.
Yeah, it's pretty positive out there right now. We saw a 16% year-over-year increase in early stage deals getting to due diligence. As a leading provider of virtual data rooms, right, we're seeing deals 6 months before they're publicly announced in the market, and we've got a pretty broad view of the market, seeing almost 40% of the deal flow out there. So when we see that increase year over year, and we'll talk a little bit about quarter to quarter, but it bodes well for the market and for deals that'll be announced through Q3 and into Q4 as well.
What sectors do you think, we might see a little bit more M&A activity? Like, where are they focused, do you think they're, Matt?
Yeah, so we do look at it from a sector and industry perspective as well, and where we're seeing, and this should come as no surprise because I think some of these bigger deals that get announced a little earlier have driven some of this momentum. But certainly, tech, media, and telecom continues to be extremely strong, and that's really on a global basis. But that's what's driving year-over-year increases of 11% in North America in particular. What's interesting, too, is some other sectors on a regional basis, manufacturing, high-quality manufacturing assets, as well as high-quality consumer goods, both staples and non-staples, in Europe in particular, have seen some increased activity in the last quarter. And I would say that's mainly due to some of the cyclical nature of the M&A business, right? So we saw a big pop in deal flow in Q2 in the Americas last year. Everybody chased those high-quality assets there, and now we're looking a little further afield as buyers or looking to stay home if they're European acquirers.
Okay, you had a merger in the insurance sector yesterday. I believe that deal was turned down by one the company that was being acquired. Did you have that one on the radar? And what's your outlook for the insurance industry?
Yeah, I mean, insurance has been pretty strong. Partially, if you look at what's driving some of the macro trends in industries and insurance and healthcare in particular, certainly, what our own government's been doing and sort of the movement there and pushing the market is driving some of that consolidation. There's also been some private equity interest in the healthcare sector services and in insurance itself. And so, I think those factors combine, and the fact that the insurance industry, has to really acquire growth at this point to grow. You'll see further consolidation, although that seems to be a trend that industry experiences on a pretty regular and cyclical basis year after year.
Tell us a little bit more about this deal flow indicator. So basically, like, I'm just trying to get a grasp for it. The companies will come together, like, on your service there, and basically that's the spot where they can talk in obviously in confidence there and just put their deals together. Is that what it's all about?
Yeah, I mean, if you think about it, and as a former banker, I spent a lot of my time in physical data rooms, right? So, after you market your deal, if you decided to sell an asset, you hire your bankers, your lawyers, you go out there to the market, you generate some interest. The next 6 months is going to be about, okay, well, you've got some people kind of on the interested and have come to the table, but now you've got to give them enough information and collaborate with them to actually get the deal to announcement and then further to close. And so our technology facilitates that, right? The sharing of information, the
Right.
collaboration, all the back and forth. And what's really interesting and what we're seeing, on the technology platform is, after the global financial crisis and the few years after that, there were fewer deal participants in terms of the number of bidders for each transaction, right? It was pretty focused processes. You kind of knew the five guys you'd probably end up with, in that deeper due diligence. Now it's much more competitive. We're seeing more buyers. We're seeing more private equity money, looking and kicking the tires and then trying to put that money to work. And strategics are, with strong balance sheets and the ability to finance deals and stock prices that have, in some cases, in some industries at record highs, they've got to put money to work. And so it's getting pretty competitive out there. And, some of the deals, I just read about, you look at some of these deals, Relativity making that, last ditch bid for Maker to take it away from Disney is an example of, people want growth and they want to buy quality, especially technology assets, and they're going after it pretty hard. And anywhere technology can help that, that's what we do.
Matt, what percentage, I don't know if you can tell us this or not, but like what percentage on your platform when they come together of, two companies when they're talking, how many of those deals actually like go through? Is it like just a fraction of it? Like do a lot of companies just talk a lot on there and or is it when they start?
Yeah, once you get to that deeper due diligence phase, right, you've gone through and you've already gotten a letter of intent in some cases, or at least indications of interest in first-round bids from buyers. It's gotten pretty serious.
Okay.
There's a percentage, probably about 10 to 15% of the deals that are on our system that have already been announced. Some of these bigger deals where they just know they can't keep it quiet and, to public companies, and so the diligence happens sort of after that kind of pre-announcement period. There is a portion of deals that, go all the way down the path, get final bids, and, the banker, the advisors and the client just determine that, this isn't enough, the valuation gap's too big, or there's some, cultural mismatch or fit, or management doesn't feel like they have a good landing zone. And, that's probably about 20% of deals that sort of, fail after that initial kind of deep dive due diligence. Now, still a good, healthy portion of those will give it the old college try again and go down that path and eventually get sold or find an investor.
Okay, so the participants on your platform, they're public as well as private companies, and the reason I'm asking this is, Facebook has just went on a buying spree here, and
Yeah.
obviously using their stock and as to pay for these
Their
trades,
currency, yeah.
their currency and jamming it. I mean, people they got that stock, WhatsApp, these other things. I mean, they got it. They got it high. So are you looking on that? Are you guys looking at transitions like that, or are you just looking between public companies?
No, I mean it's definitely. I would say the bigger public deals are not the vast majority, right? The majority of M&A is usually larger companies, public acquirers, buying assets, growing, either regional expansion or product expansion, buying some smaller competitors, buying technology. That's the typical, type of deal. And that's why when we look at like the telecom, media and technology sectors, and a lot of those, you talk about those sectors, they kind of merge into it, right? Is that really a tech deal or is that a media deal when you look at, stuff like WhatsApp? Some of those are driven by I want to own the technology. Some of it's driven by I want to own a larger portion of the user base and expand my ability to gain more mind share in the market. Those are the types of deals that we see pretty regularly is people finding, kind of those niche assets. If you think about the average value of deals on our system, it's about $300 million, right? You've got, $20 billion big public deals getting done, and you've got, bolt-on acquisitions of private equity-owned firms, in the $50, $100 million range. So it runs the gambit, but, there's certainly, right now enough public acquirers who recognize if you buy some of these bolt-on assets, if you have a strategy to acquire multiple things and grow into multiple markets, you're being rewarded now, right? I mean, people, whether some of it's buzzworthy or really actual, ability to execute on the strategy, I think the jury's still out. But certainly the shareholders and the investors out there, see the need for these companies to make these moves.
Okay, we've had Matt Porzio, VP of Product Marketing at Intralinks, giving us his outlook on the merger and acquisition. Doesn't see things slowing down for now. You can take a look at his deal flow indicator. Matt, thanks a lot for coming on again, and we'll definitely keep in mind merger and activity still to be strong in the next quarter. Have a good day,
Great. Thanks,
Matt.
Joel.
Okay, thank you.
Take
Thanks,
care.
Matt.